Let's just be honest for a second. It feels like we're living in a constant state of alert, doesn't it? The headlines are always flashing, tensions are rising somewhere in the world, and that feeling of uncertainty, well, it can really start to creep into your life, especially when you think about your money. So it's totally natural to feel anxious about what the future holds for everything you've worked so hard for. And that really is the big question, isn't it? When the world feels this unpredictable, our first instinct is just to protect what we have. But what's the smartest way to actually do that? How do you shield your wealth from these huge global shocks that are completely out of your control? All right, let's dive in and figure this out together. So, to put this all into perspective, as of right now, there are 46 active conflicts happening across the globe. Just hearing a number like that is, well, it's enough to make any investor pretty nervous. And you know what? For good reason. Uncertainty almost always leads to fear in the markets. When we get scared, what's our gut reaction? It's to pull back, right? We think about selling stocks, we hit pause on our investments, and we start piling up cash because it feels real, it feels tangible and secure and safe. But what if that instinct, that feeling of safety, is actually an illusion? What if holding cash is one of the riskiest things you can do during a major crisis? To get to the bottom of this, we're going to turn to someone who has navigated more than a few of these global crises, the legendary investor Warren Buffett. And I got to tell you, his advice might really surprise you. It kind of goes against everything our instincts are screaming at us to do. Yeah, that's a direct quote from a 2014 interview. Just let that sink in for a second. In the face of a potential world war, one of the greatest investors in history says his plan is to keep buying, not sell, not run and hide in cash, buy. So that just begs the question, what does he know that most of us don't? Well, to really get his logic, we have to look back. See, Buffett's philosophy isn't just based on a gut feeling, it's based on history. And there is no better case study for extreme worldwide uncertainty than the Second World War. Okay, so let's walk through this timeline. In December 1941, after the attack on Pearl Harbor, the market did exactly what you'd expect it to do. It panicked. By May of 1942, it had fallen almost 17%. I mean, that was a truly scary time to be an investor. But look at what happened next. By August 1945, when the war was finally over, investors who just held on weren't just back to where they started. They were up 62%. The market didn't just survive the worst global conflict in modern history, it actually thrived. So this little history lesson shows us that the stock market can be surprisingly resilient, but it also points to the real danger that Buffett is actually worried about. It's not the big, dramatic market drops you see on the news that pose the biggest long-term threat. Now, it's something much quieter, a much more insidious force that just eats away at your savings. And we are talking about inflation. Here's a way to think about it. The cash that's sitting in your bank account, it's like a block of ice on a hot day. Even if you don't touch it, it's constantly, silently melting away. Every single dollar you have buys a little bit less today than it did yesterday. And during a major conflict, that melting process, it goes into overdrive. And here's why that happens. In pretty much every major war in history, governments have to fund these immense war efforts. And how do they do that? They print more money. That new money floods the system, and you guessed it, devalues the currency. So the key takeaway here is that while you were trying to protect your cash from a market crash, inflation was silently stealing its value the entire time. So if cash is the loser in this situation, what's the winner? What's the alternative? Well, this brings us to the very heart of Buffett's strategy, something he calls the productivity shield. It's all about owning things that actually do something. And this slide really breaks it down perfectly. It's comparing gotovina, which is just Croatian for cash, on the left, with produktivna imovina, productive assets, on the right. And just like we talked about, cash is a passive asset. It just sits there losing its purchasing power to inflation. But productive assets, they're active. They hold or even increase their value because they're tied to real production, the creation of actual goods and services people need, not just a government's promise. So what exactly are these assets? They're probably simpler than you think. Stocks aren't just little tickers on a screen. They're actual ownership in real businesses that make things and provide services that people need no matter what's happening in the world. Farmland, it produces food, which is about as fundamental as it gets. And real estate provides shelter and can generate rental income. You see the pattern? They all create tangible, real-world value. And that is the absolute best defense against a currency that's losing its own value. Okay, so this all makes sense in theory, right?
But how do you take this big picture wisdom and turn it into a practical plan for yourself? Let's break it down into a simple 3-step strategy you can actually use to protect your own wealth.
First things first, acknowledge the fear, but don't let it be the one driving the car. The emotional decision to just sell everything and run for the hills is almost always the wrong one. Step 2, put your money to work. Instead of letting cash just sit there and melt away, you gradually invest it in a diversified mix of those productive assets we talked about. And finally, step 3, and this is the big one, think long-term. Just remember what happened in World War II. Markets always recover. True lasting wealth is built by owning a piece of productive businesses and assets through all the cycles, not by trying to perfectly time them.
And ultimately, that's what this is all about. You can't predict global crises, you can't prevent them. And trying to dodge every single storm that comes along will just leave you exhausted and probably in the wrong place at the wrong time. The real strategy is to build a financial portfolio that's so resilient, so grounded in real value, that it can navigate right through the turbulence and reach the calm waters on the other side. So the final question I want to leave you with is a personal one. Take an honest look at your own strategy. Is it built on fear, just hoping to avoid the storm? Or is it built on a solid foundation of productivity, ready to withstand it?